As the major stock indices hit new record highs, many are left wondering how such a bull market can develop while the average worker faces layoffs, lower wages, and rising costs. The answer presents itself in the documented, admitted, and openly acknowledged manipulations of the markets by governments, central bankers, and financial institutions. This is the GRTV Backgrounder on Global Research TV. In the age of quantitative easing and overt government intervention in the economy, it's impossible to trust any of the economic statistics that we are being shown as indicators of the supposed health of that economy. Whether it is GDP numbers, manufacturing data, inflation statistics, or housing figures, all of the macroeconomic data that drives the financial news agenda are manipulated to suit the propagandistic purposes of the government and the central bankers. A striking case in point presented itself late last year when Ben Bernanke and the Federal Reserve announced they were tying the latest round of quantitative easing not to a set period of time or set amount of funds, but to an unemployment rate target. The move puzzled many analysts at the time, as the unemployment rate has never been within the mandate of the Federal Reserve. In fact, the privately owned central bank doesn't even possess a direct mechanism for influencing the number. The move was perfectly understandable, however, to those analysts who understand that unemployment figures are one of the most flagrantly manipulable government-issued statistics, subject to all sorts of arbitrary definitions in the meaning of the term unemployment itself. One of the premier statisticians keeping track of the real unemployment rate in the US is John Williams of shadowstats.com. In 2009, he appeared on the Corbett Report to discuss how this figure is manipulated.
If you ask the average person whether or not he or she is unemployed, it doesn't take too long to get a response. The average person knows whether he or she is unemployed. They don't have to think about it. However, if you think you're unemployed, that may not necessarily match the government's definition. The government publishes 6 levels of unemployment. They have a level U1, U for unemployment, up through U6. What's standardly considered unemployed by the government is that they haven't looked for work in the last year. The reason they haven't done that is that there are no jobs to be had where they live. Well, back in 1994, all these series were redefined. The questions were redefined, and up through that point in time, a discouraged worker had been considered someone, who, again, was without work, willing and able to work, but hadn't looked for work because there was no job to be had. There was no time limit on it. You could have been discouraged for 2 years. You could have been discouraged for 5 years. Didn't make any difference how long you hadn't looked. At that time, it was redefined that if you hadn't looked for work in the last year, you were just considered discouraged. But if it was more than a year, if you hadn't looked for work in, say, 2 years or 5 years, you were no longer counted. And that knocked several million people off the rolls of the unemployed, the broader measures of the unemployed. I estimate what that number would be now if they still counted the discouraged workers the way they were counted back in 1994 and before, and on that basis, I would say that the broad unemployment rate is probably around 20%. If you went around and just asked people, are you unemployed or not, the response you'd get would be in the 20% range.
As flagrant as the manipulation in unemployment statistics has been, perhaps even more brazen in recent years has been the manipulation of stocks and equity markets. Economic commentators are again pointing to all-time record highs on the Dow and other major stock indices as sure signs of economic recovery. And the mainstream talking heads are reporting the moves in these markets with all the breathless hyperbole of excited children. What many who are living through this age of jobless recovery know all too well, however, is that these markets, too, are hopelessly manipulated, and that the trading taking place in these markets is subject to the very same parlor tricks that define the unemployment statistics. What many may be surprised to learn, however, is that government manipulation of these markets is on the record and openly admitted. On October 19, 1987, stock markets around the world crashed, from Hong Kong to Europe to the US. The Dow Jones plummeted over 22% in a matter of hours. Ostensibly in response to this crisis, President Reagan signed into law Executive Order 12631, establishing a body formerly known as the President's Working Group on Financial Markets. This body, famously dubbed the Plunge Protection Team by the Washington Post in 1997, is explicitly mandated to maintain investor confidence in U.S. markets through whatever action it deems necessary. The group and its actions are shrouded in official secrecy, but its actions have long been identified by independent market analysts.
Just keep your eye on the last hour of trading. These are all intraday charts. This is from February 22nd, 2008. In the last hour of the day, everything is popped up. That's the Dow Jones Industrial Average. The next chart is the German ETF. Same day, 3 o'clock, same pattern. Big volume starts. Guess who? Somebody's always out there buying. This is the Mexican ETF. Chinese ETF. What time is it in China at 3 o'clock New York Standard Time? Isn't it about 3 o'clock over there in the morning? I don't know what was happening, but it sure took off. And look at that volume, too. Wow. Incredible. Incredible what these people do.
In 2011, I had the opportunity to talk to the late Bob Chapman, the economic analyst behind the International Forecaster, about the manipulations of this plunge protection team and the active collusion between government and the big traders in these market interventions.
Well, first of all, you have to believe that the markets are manipulated. It's in your face if you're watching it all. So that has to be a given. You have to understand that your government and the people who control it, they are manipulating every market 24/7, and it's legal. And the Working Group in Financial Markets, which is directed supposedly by the president, which of course it's not, was an executive order signed by Ronald Reagan in August of 1988 after the collapse in the stock market on October the 19th, 1987. And that was the excuse. And I watched the markets. And being an ex-trader, I look for the rhythm of the markets. And the markets are an art form. There's nothing scientific about them. Those people who are using algorithms only have them work because their 16 computers are right next to the New York Stock Exchange computer, and they're front-running every trade in nanoseconds. That's how they can get away with it.
Just as in all other areas of life, it is a truism that those things which are suppressed in one place tend to rise to the surface unexpectedly elsewhere. Such is the case with market manipulation. Although it is relatively easy for the federal government and institutional investors to send prices up or down through relatively straightforward manipulation, it is more difficult to prevent those interventions from becoming visible in other parts of the economy. One of the first places one would look for signs of tampering in equity markets would be commodities, goods which are physical and quantifiable and thus harder to fudge or play around with. And amongst commodities, precious metals like gold and silver have long held a special place in showing signs of currency manipulation or market intervention by spiking in value during periods of currency debasement and falling during periods of true economic growth. Given that gold has been unable to break through the $2,000 an ounce level and has recently fallen back under $1,600, we are left with two options. Either the economy is truly growing and thriving as the government says it is, or these markets too are being manipulated. Sadly, if not surprisingly, the latter turns out to be the case. Gold market analysts have long pointed to the increasing amount of gold stocks, ETFs, and other forms of so-called paper gold in the market. In 2010, Adrian Douglas estimated that there were about 45 paper claims for every ounce of physical gold in existence, meaning that the true price of gold was closer to $54,000 an ounce. Beyond this simple price suppression technique, however, are the ways that large traders use the gold carry trade, futures markets, and other methods to keep precious metal markets trading below their real values. In startling testimony before the Commodity Futures Trading Commission in 2010, Bill Murphy of the Gold Antitrust Action Committee laid out a blistering expose of the systemic manipulation of the precious metals markets with the participation of some of the highest-ranking economic officials in the U.S. government. As an executive at Goldman Sachs in London, Robert Rubin developed an idea to borrow gold from central banks at minimal interest rates, around 1%, sell the bullion for cash, and use the cash to fund Goldman Sachs' operations. Rubin was confident that central banks would control the gold price with ever more leasing or outright sales of their gold reserves, and that consequently the borrowed gold could be bought back without difficulty. This was the beginning of the gold carry trade. When Rubin became U.S. Treasury Secretary, he made it government policy to surreptitiously operate an identical gold carry trade, but on a much larger scale. This became the principal mechanism of what was called the strong dollar policy. Subsequent Treasury Secretaries have repeated a commitment to a strong dollar, suggesting that they were continuing to feed official gold into the market, more or less clandestinely, to support the dollar and suppress interest rates and precious metal prices. Forced to deliver the rest of his testimony at breakneck speed to read the full remarks into the record in the 5 minutes allotted to him, Murphy continued.
God has evidence there are huge physical short positions in the gold market that cannot be covered. Growing stress caused by burgeoning physical demand is threatening to lead to a price explosion, which restore to the markets the balance that regulations failed to maintain. In our view, the COMEX paper market will become dysfunctional.
You can just try to finish up.
We're finishing up. With force majeure having to be declared as the concentrated shorts are unable to deliver on their obligations. We urge the CFTC to report fully and candidly on these markets and take appropriate action. Thank you.
Thank you. I want to thank all of our.
In 2010, I had the opportunity to interview Bill Murphy about the Gold Antitrust Action Committee and the gold market manipulations they have uncovered.
Well, we were formed by myself and Chris Powell, Secretary Treasurer and editor of the daily newspaper in January of 1999 to expose the manipulation of the price of gold and silver too. Initially, we realized that we thought it was just the bullion banks like Goldman Sachs and J.P. Morgan Chase and so on, but as time went by, another year or so, we realized that the government was very much involved, and that included the Federal Reserve, the Treasury, the Bank for International Settlements, the IMF, and so on. And it's been quite pervasive, and of course, gold's been fixed and rigged for many times over the last 80, 90 years, or at least the last 80 years, and it's no change now, except it's being done surreptitiously.
That's right. Well, let's talk a little bit about the mechanism by which that's done and who you believe is behind this.
Well, yeah, Goldman Sachs used to be the ringleader, but all of a sudden we can't find them around anymore. But it's the bullion banks, and along with the government, and it's very simple actually in the way they do it, although some of the details are complicated. Is that the bullion banks will borrow gold from the central banks and in a clandestine fashion feed it into the marketplace. And then in the meantime, their derivative traders, right now the big ones are with high concentrations in short position gold and silver, HSBC, a bank, and J.P. Morgan Chase. And what they'll do is they'll do it in concerted action, go after the futures market and go after the longs in the market and to flush them out. And they've been, even recently, we've had just straight down moves, and markets just don't trade like that all the time. I mean, if you look at the gold market and silver market, they just look like waterfalls. And we know for a fact that this is being done because we exposed this at the CFTC hearing on March 25th, in which a whistleblower, Andrew McGuire, had been in contact with the CFTC since last November, and this was on, as I said, March 25th of this year, and he told them when they were going to raid their market. And they would tell all their buddies, here's what's going to happen, and other institutions, and then they would go ahead at the same time, and the specs would get slaughtered. And this is against the law, and this is why we have antitrust laws in the United States.
The picture that is being painted here is one of a thoroughgoing fraud. In fact, even in this relatively short and necessarily incomplete expose, we have the sense of a fraud so large and so ensconced in the marketplace that it would be impossible to perpetrate without the active collusion of the government regulators themselves. Sadly, as the existence of bodies like the Plunge Protection Team and the failure of the CFTC to prosecute demonstrable market manipulation shows, this type of thoroughgoing collusion is precisely the case. This leaves the average working man or woman in the grip of a seemingly intractable problem. They have been told all their lives to entrust their savings to the financial experts, believing that a healthy portfolio of stocks and bonds will protect and even grow their wealth so that there will be a nice nest egg left over for their retirement. As this economic house of cards begins to topple, however, people will find themselves in the exact same position as the Romans under Diocletian, or the French of the Revolution, or the Germans in the Weimar Republic, or the Argentinians under the collapsing peso, having their entire life savings wiped out seemingly overnight. The only real protection from this, of course, is to withdraw our investments from the system that is perpetrating this fraud, from the stocks and bonds and traditional reserves of the fraudulent market. Instead, people around the world are beginning to learn the importance of investing in land and other physical assets, but perhaps more importantly, the need to invest in their local communities, in alternative currencies, in cooperatives and other institutions that have nothing to do with the actions of the fat cats on Wall Street or the political puppets in Washington. And until that realization happens on a mass level, people will continue to operate in good faith in the reality of this economic wonderland, never understanding the systemic collapse that is awaiting them. For more on this story and other breaking news and current events, please go to globalresearch.ca. For more research and analysis by James Corbett, please go to corbettreport.com.